From the University of Westminster, this is the Week Ahead with Dave Coker.
Hi guys, welcome to the Week Ahead. It's Sunday, February 21st. My name's Dave Coker. Let's see what's going to be happening in the markets over the next 5 trading days. First up, some key events. We're starting to see Treasury yields rise. And this is a little concerning for some people holding equities because as Treasury yields, the risk-free rate, in other words, increases, risky equities are less attractive. And rising interest rates, of course, do impact the valuation of shares. So keep your eye on that. It's been going on for about the past month. We're starting to see it pick up speed. Another thing, there we go. Bitcoin, $1 trillion in market cap. Pretty substantial move up over the past 30 days or so. Pay attention to it. A lot of people are forecasting a drop. I'm not convinced we're going to see a sharp drop like we've seen before, but we know that even though it's still volatile, the volatility has been mitigating if you compare back to, say, 3 years ago or even 2 years ago. And also keep in mind, guys, that there's only 21 million Bitcoins can ever be mined. We're currently running about 18.7 million, and institutional adoption is starting to increase. So as institutional investors, if they continue to acquire or gain exposure, I should say, to Bitcoin, we're definitely going to see demand go up, and that will naturally drive the price up. It's a really fascinating time to be holding Bitcoin at this point. Oil. We're starting to see some changes in the oil market. Watch this because Texas is coming back online. Buffett's letter to shareholders, I believe that's coming out Saturday, but it's still in the week ahead. All right, pay attention to it, guys. His letters are epic, and they're really legendary when you read them. He's very honest, very forthright. He'll talk about the markets. Really interesting to see what he's going to say about crypto and some other events that we've had. And Q4 earnings are continuing. All right. Take a look at this S&P 500. This is as of the close of the market on February 19th. Once again, you know how to read this. It goes from negative to positive, negative 30% to plus 30%. And negative is expressed in red. Price falls are expressed in red. And green is price gains. And we can see here the market's a little mixed, guys. Microsoft up some 8.34%. Oh, Apple got spanked a little bit. Look at that. That's very fascinating that Apple got hit, down some 2.13%. You can see Google's doing pretty well compared to other shares rather that are in that area in that sector where Google is. Amazon down, Tesla up. It's a very, very odd market. And down in the lower left-hand corner, take a look at banks. JP Morgan up some 16.49%. Bank of America up roughly 13.47%. And then we've got other companies in there, and they're all benefiting from this increased yield. In other words, the yield curve is starting to steepen, and because of that, they're starting to benefit from the spread between short-term borrowing rates, what they have to pay depositors to acquire money, and what they can lend it out over time on. Here I've got the S&P 500, and now we're looking at price to earnings ratios. My God, guys, this is really, you don't have to look any further than this to see the evidence that the market is really, really overvalued. Here's how you read it. Keep in mind, guys, and again, you already know how to do this because it's a standard color. Keep in mind, guys, the long-run average price-to-earnings ratio for the U.S. is roughly 17. So when we see shares like Amazon trading for 77.83, Apple 35.11, even Microsoft, they're massively, massively overpriced on a PE basis alone. Keep in mind, valuation is not an exact science, and there's different metrics we can look at. But when we consider the market, when we consider the components of the S&P 500 on a price-to-earnings basis, lots of stocks overvalued, some significantly. Look at that, Berkshire Hathaway down there. Sort of cool. Not really overvalued at that point. You can see JP Morgan coming in at 16.65. As I mentioned, guys, the market, the long-run PE is roughly 17. So JP Morgan's right in line. And Bank of America looks a little red there to me. On Monday, February 22nd, my animation's messed up again. Okay, at 1000 hours, we've got U.S. leading index, month on month for January. Now, this is another one of these metrics that I like to look at and I like to tell you guys about. Of course, we could look at different leading, coincidental, and lagging indicators of U.S. economic performance: unemployment, GDP, interest rates, the list goes on, consumer confidence. But when we take the U.S. leading index, what we're doing is we're averaging them together. And there is, I do like this because it does tend to filter out the noise. In other words, we know any single metric can jump up, jump down. I mean, just look what GDP's done over the past year. So when we average these together, we get a smoothing function. Prior was 3/10, forecast to come in at 4/10 as well. Uh, we'll have to pay attention to this, guys. It'll be really fascinating to see exactly what happens. Because once again, this will give us some indication about what people are expecting with the performance of the U.S. economy. 11:30, 3-month and 6-month T-bill auctions, 0.4%, 0.6% prior for those two bills respectively. Got a chart down here. I'm going back 3 months, and you can see here we're starting to see a little push up in interest rates. They're still absurdly low, even though they're starting to pump up a little. Not that they were much higher before. If you go back to December, or even to before that to November, no, interest rates are absurdly low. It's what I call return-free risk. On Tuesday, February 23rd, we got the house price index. And guys, again, this is one of these metrics that I like to bring to your attention. What we're doing here is we're measuring the average price of homes across the continental United States. So it's not like the Case-Shiller 20 urban areas. It's a little bit broader. And we're seeing the prior was 11%. We don't have a forecast. But again, these are stunning increases in house prices. Year on year, the prior one was 11%. That's absolutely amazing. 1000 hours, the Consumer Conference Board Consumer Confidence Indicator for February is coming out. Prior was 89.3, forecast to come in at 90. The consumer is confident. The consumer is still splashing out, even though the economy in the States is teetering to some extent. At 1000 hours, we've got Fed Chair Powell speaking. And once again, when he's speaking, you really want to pay attention to what he's up to, guys. He'll be speaking at the Joint Economic Committee in Washington. This is a two-part presentation that he's giving. The first is he'll have a prepared statement. Typically, it runs about 15 to 20 minutes. And then the committee will conduct Q&A sessions. So they'll ask questions that they either walked in the door with or that were triggered by his testimony. So we do need to pay attention to this, or we do need to be aware that it's happening on Tuesday, February 23rd, because we tend to see a lot of market volatility. At least historically, there's been market volatility, depending upon what he's saying. So we could see things get a little hot in the U.S. equity markets then. On Wednesday, February 24th, new home sales, bright and early, right? Prior was 842,000, forecast to come in at 855. That's for the month of January. Those are new homes only. And once again, this is a good thing to watch, because when homes are sold, when somebody's going to move in, they do need to customize it, fix it up a little bit for their own, reflect their own taste. And a lot of times people, when they move into a new home, I should say, they use that as an opportunity basically to replace all the white goods, as we call them. So refrigerator, freezer, things like that. And also there's jobs for decorators to come in, painters and people to do walls and things along those lines. At 10:30 hours, crude oil inventories. Prior was a contraction, a drop of 7.2 million, roughly, barrels. Forecasted to come in at a drop of about 2.4 million barrels. On Thursday, February 25th, we see at 08:30 hours, we got durable goods orders, month on month for January. Prior was 0.5%. We're forecast to come in at 1.1. In other words, we're starting to see an uptick, because this measures orders, new orders, for long-lasting goods, manufactured goods. And this would include transportation items as well, things that are built and last for a while. And so it's a good reflection of economic activity. FOMC member Bostic is speaking at 8:30. And also at 8:30, GDP quarter-on-quarter Q4 2020 rather. Prior was 4%, forecast to come in at 4.1%. Any other time, those numbers would be stunning, but we are coming off a very, very sharp contraction that happened last year. Friday, February 26th at 08:30 hours, personal consumption, real personal consumption, month on month for January. And what we're doing is we're looking at consumption. It factors in goods and services. And then when we take a look at goods, we're further breaking it down into durable and other items like that. So it's really important to watch this because this gives an idea of what's going on with the economy. Are people splashing out or not? Prior was a 0.6% contraction. We don't have a forecast. It is an important number though. And rounding out the week, guys, at 1000 hours, Michigan consumer expectations for February. Yeah, this is a good one to keep an eye on. They survey, I believe, 2,500 consumers, try to get an idea of what they think is going to happen to the economy going forward. And prior came in at 68.8. We don't have a lead on forecast, but again, it's an important one to watch. All right, guys, that's been it for the week ahead. Once again, I wish you have a happy, safe, and productive week. Keep an eye on the markets. Deploy your capital properly. Make sure you're aware of news that's upcoming and how it can impact the value of your investments. And guys, remember, don't try to trade. Just buy and hold. Buy yourself some decent dividend-paying stocks. Sit back and get rich slowly. It's the only way to be sure. Take care.